C3.ai reported quarterly financial results after the stock markets closed on September 3rd, 2025. That sent the stock price crashing. In this video, I'm going to share with you the details of why the stock price crashed, and I'll also share with you if I think this is a buying opportunity on the dip. Remember, coming into this quarterly earnings release, I told investors not to buy this stock. I told investors that the risk versus reward was not worthwhile for this investment. So now I'll share with you what I think about the stock at the new lower valuation. I'll look at the quarterly financial results. I'll also share with you my updated proprietary discounted cash flow valuation that calculates a fair value for this stock. I'll discuss the CEO change and the causes of that big revenue decline as it related to the CEO change. That's a lot to cover in a short video, so let's get right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so C3.ai reported total revenue for the quarter came in at $70.3 million. Now, whenever you see a company report total revenue without sharing with you whether this was an increase or a decrease, you should automatically have the alarm bells going off. Usually, when a company has big revenue growth, they will highlight it and they will present it to you with big, bold numbers and adjectives. Here, the company strategically leaves out whether or not this revenue was more or less than the same quarter they reported last year. And that should be a hint to everyone that this revenue number was less than where it was last year. So the business decreased year over year, which is bad news for investors, which is, I think, the reason why the company leaves it out here in the front page, right at the top of the page. They don't want to reveal that information so quickly. They like to bury it like in page 8 of the financial reports. It's not just C3.ai that does this. I've seen many companies do this, where if the number is not appealing, they'll bury it down lower in their press release. So as soon as I saw that, I knew the results were not good, and the management team went on to talk about that. So they talk about the bad news is that the financial performance in Q1 was completely unacceptable. Having given this a lot of thought, I attribute this to two factors. First, it's clear that in the short term, the reorganization with new sales and services leadership had a disruptive effect. Secondly, as we have previously announced, I have had a number of unanticipated health issues, and unfortunately, this prevented him from participating in the sales process as actively as I have in the past. And the CEO in this company looks like he had a lot to do with completing sales, at least for the larger contracts. And so the CEO, of course, through no fault of his own, had an unanticipated health issue. And since he wasn't able to participate in that sales process, it looks like the company wasn't able to close as many deals as it would have hoped. Still, this is a company that generates a lot of its revenue from backlog, from orders that it signed several months ago and several years ago. So it was a little troubling to see that the company's revenue came in where it came in. Right? So there was a big change of leadership as a result of the health issue, and they announced that Stefan Ehikian, CEO of C3.ai, will be effective September 1st. So already taking effect as you're watching this video. But what I really liked here is that Mr. Seibel, which was the previous CEO who had this health issue, will remain at C3.ai and now in the role of executive chairman. So whenever there's a leadership change at the top, especially when it's an abrupt leadership change like this one, not a planned leadership change, I like when the previous CEO stays on board through some advisory fashion to help onboard and advise the new CEO that's coming in, because the new CEO is going to have a lot of questions about what's going on at the company. And it's nice to have that previous CEO as a resource to call and email and ask questions about certain things that you may not know how to handle in that situation. So this makes the transition a little more seamless as seamless as it can be when you have an abrupt change like this at the top. So looking ahead, the management expects the poor results to continue for at least one more quarter. They're guiding second quarter fiscal revenue of 76 million at the midpoint. That would be slightly above the roughly 70 million they reported in the first quarter, which was a big decrease from the same time last year. So they are forecasting revenue decreases in the upcoming quarter. And of course, this company has been losing money on the bottom line for a long time, and they're forecasting continued losses ahead. All right, here we go. Page 8 of the press release is where I finally found the company's comparison with the revenue growth from the previous year. So this is something that annoys me as an analyst, but it doesn't make any changes in my investment decision. It's just annoying that the company will go and bury this kind of information and make you go all the way to page 8 before you see this very important information. Total revenue came in at 70.26 million, and compared to the same quarter last year, where it came in at 87.2 million. So year-over-year decline of 17 million in the company's revenue. What's more unfortunate is the cost increased. Even though revenue is decreasing, the total cost of revenue increased to 43.8 million, up from 35 million, and the loss from operations increased to 125 million, up from 72.6 million, and costs were increasing across the board in all categories: in sales and marketing, research and development, general and administrative cost increasing across the board. And the one category that is my least favorite for increases in cost is general and administrative. These are things like spending on your corporate headquarters, furniture for the CEO's office, and staffing and general infrastructure back end. These are things that are not really helping the company generate competitive advantage, but they are building in cost. I'd like to see these costs remain relatively flat after a certain point, and for most of the spending to go into categories like research and development. For an AI company like C3.ai, I would like to see the research and development spending increase, because that usually leads to breakthroughs in new products and services that generate competitive advantages and cash flow longer term. All right, so now that the stock price crashed following the earnings release, remember I did a video around July 23rd where I told investors not to buy C3.ai stock. I kept it rated as a hold. And now the stock price is down near its 52-week low, is trading at $16 per share. The intrinsic value per share I calculated is $30. So it's now trading at a significant undervaluation to my intrinsic value per share calculation. Still, the risks are extremely elevated with this business right now. They're going through a leadership change at the top that's already impacting sales and profits negatively. What's more, the management team is forecasting a continued decline in sales, with losses on the bottom line continuing. So this is a company that was already a high risk investment, but now those risks are magnified further given the changes at the top and given the restructuring of the sales organization, then the declines in revenue. Still, I think the undervaluation is now significant enough where investors can now start buying this stock. So I am upgrading this stock today. I had it previously rated as a hold, and I've had it rated as a hold for the longest time. I don't think I've had this stock ever rated as a buy before. But today I am upgrading this stock to a buy, even though this is a high risk investment. This should only be for those investors that are willing to tolerate above average risk or very high risk in exchange for the potential for high rewards. So this shouldn't be for the risk averse investor, especially now following the company's transition. I think the risks are elevated further. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.